Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, noisy numbers, and hyperbole to give you the information you need for your portfolio. I'm Jared Blikre, and today I'm joined by Ann Berry. She is the Threadneedle Ventures founder and CEO, along with Brian Nick. He is the Macro Institute Chief Investment Strategist. Thank you for joining us today. In case you're wondering about Sydney, our producer, she's going to join us next week. She has a day off. Now, on the docket for today, we're going to be talking about labor, and this is in terms of jobs. We got the JOLTS numbers today. We're going to explain what those are. Jobless claims, big monthly numbers this Friday from the BLS. We're going to break it all down to you. And our word of the day is TBAC. That stands for Treasury Borrowing Advisory Committee. Bureaucratic and impersonal sounding as it may be, we're going to tell you why this clandestine group of bond barons is key to America's debt profile. And this episode brought to you by the number 174. That is the number of S&P 500 companies reporting earnings this week. Of the Mag 7, only Apple remains, but that's just the tip of the iceberg. So, Ann and Brian, let's get to this story of the week, labor. I mentioned JOLTS. This is the March numbers, and this is kind of an in-depth labor survey that tells us how many people are quitting, what the openings look like, and it was a bit of a disappointment. We've seen some numbers weakening here, but in terms of the monthly numbers, we've had just a string of really outsized payrolls numbers. So let's begin with you, Brian. What do you think of the labor situation and all these numbers that we've been getting?
I think there's pretty clear evidence now across a number of different surveys, including the JOLTS one that you just referenced, that the labor market is less tight, less strong than it was 6 months ago and a year ago. I think it's natural. We were starting from a standpoint where there was a lot of job openings relative to history, relatively large numbers of people were quitting their jobs, and we've seen both of those start to come back down to normal. Now, the March numbers were, in some sense, uncomfortably soft. If you're looking for sort of a soft landing or a return to pre-COVID immediately, 2019 fourth quarter, the quits number is now below that, and so is the hiring number. So there's less hiring going on, fewer people quitting their jobs, which means that incrementally you'd expect wage growth to be continuing to decelerate from here. And we have a couple of different measures of wage growth out this week, including Friday's, which will be average hourly earnings. For the most part, not every measure, like not employment cost index that came out earlier.
Yeah, that's an interesting. We'll get to that.
That was a little bit of an exception, but most of them are heading in the right direction if you are looking to avoid a wage price spiral that would cause the Fed hikes to come back into the table and cause rates to go back up from where they already are.
Yeah, wage price cycle. That's something that the Fed is scared of. That's when wages rise, which is generally a good thing, but then prices of goods rise as a result in reaction to people having more money in their pocket. So it could be a virtuous or an unvirtuous cycle. And your big picture thoughts about labor?
Well, I took a look at the JOLTS chart, and I love, you're a charts guy, Jared, right? That's your jam, right? So I took a look at the chart, and you're right, Brian, relative to the last 2 or 3 years, the JOLTS number that came out was softer. But relative to the longer period of history, if you look at the number of job openings, just that number of job openings, it's still significantly higher than it was prior to COVID. So yes, it feels like things are getting a little softer, but it's still a really robust labor market when you take a big step back. That was my takeaway.
Well, good. And let me ask you guys about this employment cost index. Now, this is a number that came out, I believe it was Tuesday, and this is a quarterly number, but it's computed by the BLS. They're going to give us those numbers Friday, and it points to elevated labor costs, and the market reacted to it. This is a number, it's rearward facing, so I think the market's reaction to this ancient number by trading standards is kind of significant here. What are your thoughts?
This is your classic, we care about it because we know the Fed cares about it. Just like job openings, the ratio of job openings to unemployed workers, that was really high, like 2 a couple of quarters ago, and now it's down to 1.3. The Fed wants that to be at 1. Same with employment cost index. They reference this. Powell may reference it in his press conference or at the Fed. We're recording before that meeting, but this is going to be one of those things that if you're looking for balance on inflation, if you're looking for balance from the Fed on, well, maybe we have to keep rates a little bit higher, maybe we need to be starting to think about cutting rates, higher employment costs are going to be something that gives evidence to the hawks on the FOMC who want to keep rates higher for longer. And that's why that market reaction was as strong as it was, because the market was looking for deceleration. That's not what it got.
Yeah, and any more thoughts on labor before we move on to some of the other metrics that we're facing here?
Yeah, I was going to piggyback off what Brian was saying and talk about the data-driven Fed, right? And that data-driven word. Some of those hawks, Brian, I think, have been even more hawkish than higher for longer. In the last couple of months, I feel it's the first conversation that's been had in the public domain around could another rate hike be possible.
Thank you. The no
right?
landing, basically.
The no landing. So, continuing to watch it, I have a view on what happens today. I don't think much happens in terms of the Fed outcome, but we can't rule it out. That data is really important. You're right.
We're not that far from the Fed's core PCE inflation forecast for the end of this year already. We're only 0.2 away from that. And back in March, not that long ago, when the Fed made that forecast, the average FOMC member expected there to be 3 rate cuts this year. Now it feels like they're thinking maybe 1 or maybe none, but it doesn't seem like they're any less likely to achieve that inflation forecast, at least to me, compared to where they were in March. So I think you're right. The reaction function seems like it's gotten incrementally more hawkish. Maybe some of that's the tone of the data. ISM prices paid number, which is something that people look to as a proxy for inflation, that came out really hot as well this week. And it just feels like it's more of a shift in the vibes than it is in the actual underlying data. And how likely are we to actually get lower inflation before the end of the year?
I should point out that by the time everybody hears this, the Fed meeting will be in the rear view mirror, but we're going to talk in generalities. And nobody expects any action from this Fed meeting anyway. We're going to get color, and as always, from Powell at the presser. But what are the risks that the Fed has to raise rates again? As you said, that really hasn't been the discussion until very recently.
I love me a presser. I'm so excited for the presser, Jared. I got to tell you. Look, I think it's always the commentary that comes out, right, that gets the market excited. I think everyone's expecting that there's no rate change coming out today. But I do think there needs to be some conversation around what happens to the Fed balance sheet. We don't talk about that a lot. We talk about the rate hike as opposed to how much liquidity is actually in the system. And the signs that there's still, Jared, a ton of liquidity in the system is the markets are still incredibly strong, right? There's still liquidity infusions into the equity market. We're seeing that. Some conversation around that I would find fascinating.
I love that you mention equities because this brings us to our number of the day. That is 174. Again, that's how many S&P 500 constituents are reporting earnings this week. We had Amazon. We're looking ahead to Apple, but there's a lot more going on. We've got the AI infrastructure play. Financials have been jumping again. There's just a lot of broad strength under the hood here. And what do you think is going to happen this earnings season when we finally finish, when we kind of look in the rearview mirror from here in a few weeks?
Well, I think let's start with tech, right? Because you brought up Apple there.
Yes.
They're reporting on Thursday of this week. And tech to me has been fascinating. It's been such a tale of the market reaction to the outlook for the year, even where there's actually been pretty good reporting of the backward looking, the quarter we just had. Amazon had a really good quarter, pretty good quarter. Cloud is back, cloud growth is back. Pretty tepid response, right? Meta, very strong earnings, down, right? Because the outlook for the year was soft. Netflix, pretty decent earnings, outlook was soft. So I think it's all about for tech. Are these companies reporting forecasts for the year consistent with the most aggressive end of analyst projections? And we're seeing them actually falling short of those right now. For the rest of the market, Jared, and I'd love to hear Brian's perspective on this, when it comes to industrials, when it comes to financials, I think it's actually a lot more sort of fundamentals driven, and it's a lot more focused on the actual performance of those businesses.
All right, so maybe guidance is weak. That's one of the themes. What do you think is going to be? What do you think the theme is going to be?
Yeah, I think so. We're kind of in sympathy with the market that sees a really good quarter that we just had. We got the GDP number that mostly confirmed it was a good quarter, and after a string of good quarters at the end of last year. But we do see a likelihood that the economy is going to be much softer in the coming quarters, and I think that's why you're seeing companies get punished more for releasing, if not affirming guidance, releasing maybe even weaker guidance than had been assumed prior to that. And that's to us a sign that we're getting sort of toppy here with the market. So what we're expecting to see the next couple of months is, based on the fact the S&P has sort of taken a pause here, a little bit of a pullback in April, here in the opening hours of May, that's going to lead to, in a couple of months, analysts starting to rethink their price targets for the year, strategists starting to rethink their price targets for the year, and then eventually on the back of that, you get lower earnings estimates as well. So that's the sequence we normally see. We're not likely to see it during this earnings reporting season, but we think by the time we get to late May, June into July, the next earnings season popping up, we'll be in a little bit of a different place in terms of economic expectations. And getting back to our conversation about the Fed, more attention on a softening labor market, less on the urgency of the Fed needing to bring down inflation further.
All right, we've covered some big picture stuff with respect to earnings. I want to keep with the public markets and focus on luxury. We were all having an interesting discussion about footwear and the resurgence of luxury brands very recently. And I'd throw this out. Remember the beginning of Mag 7 last year? Well, we also had the Mag 7 in Europe, and there were these big luxury brands like Hermès and others in their cohort. But our conversation today was focusing on Vans, that is the footwear, and also Chuck Taylors and some of the more luxury brands coming back. And Ann, you got some thoughts on this?
Yeah, so luxury, like the LVMH style luxury.
So you're saying not Vans?
Well, we'll come back to Vans because that's the devil's in the detail, right? So the really big ticket luxury has seen some weakening, right? So there's a little bit of signage that the consumer is feeling some pain when it comes to these really big ticket spends. But I put Vans in a different bucket. By the way, folks, I am like the Chuck Taylor fan that brought up the Chuck Taylors.
I love this.
A little bit of Converse. These are the kind of nostalgia brands. If you think about, I can tell you how much I paid for my Chuck Taylors, right? They're super functional. They're good-looking shoes.
Under 50?
Under 50,
Yeah.
especially under 50, which makes it even more premium in terms of value. And from my perspective, the consumer seems to be drifting back towards some brands that had really been in this sort of quiet period for a while. And I put, our Vans and Converse in that bucket. Look, Birkenstock went public. It was a really good IPO. Whoever would have predicted that shoe brand was going to do as well as it was going to? And then we were talking about like Abercrombie and Fitch. Look at the resurgence that brand has had in apparel.
Big makeover there.
Say again?
Big makeover there.
Big makeover. But I put these in the bucket of affordable, quasi-luxury, like masstige.
Okay.
Doing pretty well.
Your thoughts, Brian?
So everything I know about brands comes from my daughter, who's 11.
Excellent.
I confuse her grandparents who ask what she wants for her birthday, and I just give them lists of sneakers that she wants to own, and very.
Does she want Golden Goose?
Maybe.
I'm just curious.
I don't know
Maybe.
this one.
I don't know. And there's definitely been Vans and definitely been the luxury Chuck Taylors. Two thoughts on the consumers when it pertains to those ultra luxury brands is how those brands are doing also tells you something about how things are going in Asia, because there's sort of this outsized impact on demand that comes from China. You have some cadre of sort of ultra wealthy people who really value those brands, and so that especially post GFC, that was one of the things that we were looking at for signals that the global economy was bouncing back, especially in China and East Asia, was the fact that some of those luxury brands were coming back as people wanted to spend money again. The other thing I'd say, overall consumer confidence that we saw this week that was quite weak, and a lot of commitments on the part of people who are answering the survey to cut back on spending. When you ask them, how are you going to behave over the next 6 months? I'm going to go out to eat less. I'm going to take fewer vacations. I'm going to do less fun stuff. That's all the experiential stuff that's been booming since the economy reopened post-COVID. Brands and goods generally have not been sort of the things that people have been spending their money on. If you're going to not spend the money on a concert ticket this summer, if you're not going to go on that extra vacation, if you're not going to go to that
Taylor Swift in Paris, no.
Maybe not. It sounds expensive. So if you're not going to do those ultra expensive things, you can afford to do some of those like 1 or 2 levels down, right? You can get that fancy drink from Starbucks, which we were also talking about.
But weak today. Starbucks not doing this,
but potentially
and China a big part of that, right?
People are looking for what they can cut out of their budgets. Tells you that the consumer is not feeling quite as good as they were a year ago. And so maybe it's vacations. You have to cut a lot of Starbucks out of your budget to make a difference, I think, unless you're spending way, way, way too much money on coffee and other drinks. But I think if you see people pulling back on the experiential stuff, they may be actually able to reallocate some of that budget to go more into goods, which are not going to be, from a price tag perspective, as big a hit to your bottom line.
Hold that thought for a second. For our viewers on our streaming platform, we're going to take a quick break, so stick around. For everybody else, we're going to continue with the show. All right, so we were just discussing some luxury brands, and we want to wrap up that conversation. Anne, any more thoughts there?
I've got a slightly different perspective, right, which is always fun, right, when we've got a different perspective.
Please.
Must have different perspective.
I think the outlook for travel is still pretty strong. If you listen to the airlines, they still see people getting on planes, a little bit of business travel continuing to leg back in, not yet at pre-COVID. The hotels seem pretty optimistic. Again, globally, where there's exposure to China, feels like there's vulnerability. But also take a look at the IPO pipeline, right? Viking Cruises, which is meant to be Wednesday, right? Is meant to be the biggest premium-only cruise ship name. I mean, they're picking this moment to come to market, which tells you the window is still open right now for experiential.
Well, that would just mean that people in that consumer confidence survey are not being completely honest with the survey takers or with themselves as to what they're going to do, which would not be the first time that's happened.
Yeah, and the survey results just aren't what they used to be post-pandemic. That's just kind of the way it is now. All right, time for our word of the day, and that is TBAC. That stands for the Treasury Borrowing Advisory Committee. It is a group of bond experts from some of the biggest investment banks like JP Morgan, Goldman Sachs, and they meet with the Treasury Department each quarter to figure out how the U.S. government is going to fulfill its borrowing borrowing needs, and that's a lot of money. More T-bills, more T-bonds, how much, when, all these questions they answer and advise on, from macro to micro. And we just got the Treasury Department's needs from April to June, and this is a borrowing amount. They were quite a bit higher than expected, $243 billion instead of $202 billion. And markets reacted Tuesday. Stocks took a dip and yields jumped. It wasn't a big one, but typically you don't see markets react to this kind of stuff. And so again, is there some bigger picture thing looming?
So yeah, this for the last couple of quarters has been getting more attention, I think, than it ever has before. And last year the story was that the Treasury Department was issuing a lot more T-bills. Maybe there was an interest rate call in there embedded somewhere where they thought, well, if we issue a bunch of stuff short term, rates are going to drop again, and we'll be able to go on a leg out and do 10 years and 30 years when rates are a little bit lower. Rates haven't fallen that much net since those refunding announcements last year. I do think it calls attention to the ongoing borrowing needs and the size of the deficit and the debt, which is a question we get from literally every client. Every time we do a conference call, every time we speak to individual investors, they ask, well, what about this? I mean, you're saying rates are going to go back down because the economy is going to weaken. Is that really going to happen if the Treasury continues to borrow more and more? And part of it is the cart is really ahead of the horse here, because one of the reasons the Treasury needs to borrow more could be potentially because tax receipts are lower because the economy is slowing down.
That's exactly what happened this quarter.
Yeah. So that tells us that this could get worse before it gets better, because spending is certainly not going down anytime soon. Tax receipts potentially getting lower, and we feel like ever since the tax cut in 2017 enacted for 2018, you've really had this sort of systemic widening of the budget deficit that really is not going to close. There's no chance of closing this off, given demographically what's happening, given the spending obligations that we have, unless there's a change made to ongoing entitlement program benefits or to the way that those programs are taxed.
Well, it's interesting because one of the things Jay Powell keeps hammering on, he said this exact phrase so many times over the last few years, is the borrowing or the fiscal position in the United States is on an unsustainable trajectory. And the first time he said that, I was kind of shocked, because there's supposed to be independence between the Fed and the rest of the government. But, he's saying it very broadly. And I think it's a very, very reasonable sentiment here. So, Anne, what do you think about this?
I think it's a totally independent. I think it's a show of independence that he came out and said that so explicitly, because it is a warning flag, right? Mm-hmm. And can I think, Jared, kudos for bringing up T-back as word of the day, because I do think, look, we talk all the time, what's the Fed going to do? But trying to figure that out independent of what's going on in fiscal policy is a fool's errand, right? And as we go into election season, my view is that it's going to be so much more about talking what are the presidential candidates' election promises around fiscal policy, around entitlements, and we need to spend more and more time and energy looking at, and T-back is a really important part of it. Like, I really do think the other piece of this, everyone's talking about, it's tax receipts, it's also productivity. Mm-hmm. Right? And
where's that AI productivity?
You got it, right? Everyone's going to be saying, so where is it coming from? And at some point, and it's not right now, but at some point, people are going to look at the markets and say, are the productivity promises we're seeing in corporate America coming to fruition? And if not, what does that mean for the deficit over the longer term?
All right. If we had some kind of, if we were more advanced in our production, AI has got to be the magic word of the day, and confetti would drop. Maybe we're in a green screen. We can have some funfetti here.
It's raised on Pee-wee's Playhouse. Had the secret word, and everybody would go crazy when they said
Thank you. I've been wanting for decades to bring Pee-wee's Playhouse to finance, but that's for another
mission
day.
Accomplished.
Well, we're working on that. But AI in general, the productivity benefits. Just give us your top-down view of the AI movement here.
Yeah, I think the concern is about it's going to eliminate jobs, and that's frankly every time there's some kind of technological breakthrough, internet, mechanized farming, right? The assembly line, all this stuff is going to eliminate jobs, everything, and invariably the number of jobs continues to climb. So I think the short-term benefits will be making existing workers more productive. I don't think that was the story of 2023. People say, well, there was this great productivity last year because of AI. They heard about AI more last year, but in terms of putting it into practice, what probably happened last year was you had a lot of people moving around jobs in 21, 22, and they start to get good at them in 23. So you have this giant dip when everybody's switching jobs. We talked about the quits rate, separations rate being really high in those years, went down a lot last year. Once people get good at their jobs, they get trained up a little bit, that extra productivity comes through in that experience. And so that's probably a one-off. If you want to see an ongoing self-sustaining productivity boom, you need some kind of technological breakthrough. We had the internet in the 1990s. Again, we had these other technological breakthroughs earlier. Is AI going to be a 2024 story? Potentially at the margins. I don't think it's going to affect every industry. Could eventually also affect productivity and efficiency at the government level, something I think people don't talk as much about. We talked about the deficit, maybe a way to cut some
productivity
some costs
comes
there.
to the U.S. government.
And also just not enough people applying for government jobs, right? Government jobs as a percentage of total jobs is way down from before COVID, partially because it's not offering as high a wage. So I think long term, the benefits are there. I think it's going to be a sort of a slow process as opposed to a one-time boom like dropping confetti from the ceiling, but optimistic.
Yeah, I mean, I'm very optimistic. I use it in an increasingly broad, like it's become my go-to source for search instead of, for instance, going to Google. I'll go to Gemini. I'll go to ChatGPT. And you using AI?
I am using it, but I still have this muscle which came from my days when I was starting out in my career. I was an analyst in investment banking, and the one thing that I was trained to do, and is really hammered into us, is go back and check your original sources when you're doing analysis. Make sure that the fundamental inputs, the building blocks of the ultimate decisions you make, are really watertight. So I am using it, Jared, but I'm still. Do you know there was that moment? Predates me, but it's the classic story, right? That when the telephone and the internet and email was adopted, people still sent like the just-in-case faxes, right? Just in case people didn't get their emails. I'm in that just-in-case phase of using ChatGPT. I'm still checking the underlying source.
I still get faxes, so I have no cause to give any opinion on this. We got to move on here, and it's time now for Who Wore It Better? And this is a segment we've borrowed from Hollywood. And today we're discussing digital gold versus actual gold. And it's a comparison that we love here at Stocks in Translation. Both Bitcoin and gold, priced in dollars, by the way, recently catapulted to fresh records. But we've seen prices trail off. Now, gold is off about 5% from its high, Bitcoin off about 20%. Bitcoin known to be a bit more volatile, so take that into consideration. Bottom line, the question is, who is wearing this correction better? Which one has a better chance of keeping the long-term bullish trend intact with higher highs in sight? Is it Bitcoin or is it gold? Give me your answer, please.
I have a bias. I know bias is the worst, Jared, for you as a journalist. But I have bias. I'm not a Bitcoin woman. I'm just going to say it. I don't own Bitcoin. I've never traded Bitcoin. So I'm going to have to say gold by default.
All right.
Yeah, I'm exactly the same way. I spent the early 2010s pushing back on people who wanted to turn their entire portfolio into gold. And I think I probably wished to myself, gosh, I wish people would ask about something else in sort of a monkey's paw situation. So now I get fewer questions about gold, but they're all about Bitcoin.
Yes.
Yeah, gold has more predictable correlations to other assets, has more industrial uses, has more economic uses, has, again, I think a clearer, more established relationship to monetary policy and interest rates and inflation. Bitcoin, I'm not quite sure. And that's why I don't. Like you, don't.
What did you say? A monkey paw situation?
Monkey paw. So when you be careful what you wish for.
Oh, okay, got it.
Yeah.
And that's based on people would wish on monkey paws?
Yeah. I mean, I think I could learn this from The Simpsons, like most other things I know in life.
Probably. This sounds archaic and barbaric. It's hundreds of years old.
It is terrible, and this is why people shouldn't make wishes on monkeys' paws.
Yes, and that's why humans progress here, and we're all in favor of that. By the way, my answer: I'm all crypto. I do like gold. I am the monkey's paw here. I'm going to go for crypto. I think crypto, it might take a little bit, but I think it sees record highs far and beyond, although I'm not quite in the Cathie Wood camp, somewhere in between. All right, we are winding things down here, so I'm going to get to what I am watching this week and the next. First of all, it's going to be Apple earnings after the bell on Thursday, then we got non-farm payrolls on Friday, but we also have some interesting earnings next week. We got Disney on deck, we got Uber, I think we got CoinDesk, so there's a lot going on. 15 seconds, what are you watching?
I'm watching Apple like a hawk. I think it's a bellwether for China. And, if Apple's valuation breaks, I think it gets really interesting.
Oh, I agree. What are you watching?
Home builders. Probably had a very good first quarter, but the guidance is going to be awful because of what's happened with interest rates. We already see home builder confidence topping out. We see inventories of existing homes, new homes growing. Whereas rates are going up, that's going to mean lower prices and less activity of the balance of the year.
All right, you heard it here. Brian, Ann, thank you very much. That is all for Stocks in Translation. Keep it tuned to Yahoo Finance.